Hey everyone, and welcome. If you're prepping for any of the big banking or finance exams here in India, this is one topic you absolutely can't miss. Today we're going to break down the RBI's super important framework for foreign banks, and specifically, we're diving deep into the wholly owned subsidiary model. Let's jump right in.
So let's kick things off with a pretty basic question, right? Why can't some huge global bank just waltz in and open up a branch wherever they want in India? I mean, what's stopping them? Well, the answer actually lies in a huge lesson the entire world had to learn the hard way, from a massive crisis that forced regulators everywhere to completely rethink how they handle risk.
And that crisis, of course, was the 2008 global financial crisis. It basically ripped the curtains back and showed a giant gaping hole in the global banking system. And that brings us to a couple of key terms, jargon really, that you've got to know for your exams. TBTF, which stands for too big to fail, and TCTF, or too connected to fail. We're talking about financial giants so massive that if they go down, they could drag the whole economy down with them.
So, when some of these too big to fail banks started to wobble and even collapse, it was a huge wake-up call. It made it crystal clear that a new game plan was needed. Central banks all over the world, including our own RBI, realized they had to find a way to shield their own economies from problems that started in a bank's home country thousands of miles away. And that realization led directly to the policy we're digging into today.
And here's the solution the RBI came up with: local incorporation. Now, the most important concept on this slide, a keyword you absolutely have to remember, is ring fencing. Think of it like this. By making a foreign bank create a whole separate Indian company, you're essentially building a financial fortress around our domestic system. This new Indian entity has its own money, its own board of directors, and it has to follow our laws, which gives the RBI direct control.
So this policy basically sets up two main ways a foreign bank can be present in India. And understanding the difference between these two is really the heart of this entire topic, so let's break them down piece by piece.
Okay, first up is the Wholly Owned Subsidiary, or as you'll see it everywhere, WOS. Now, for your exams, you need to lock this definition in your head. A WOS is a separate, legally distinct Indian company. Simple as that. Yes, it's owned by a foreign parent, but it's registered right here in India under the Companies Act, and crucially, it's regulated by the RBI just like any other Indian bank.
And this table here, it lays out the difference perfectly. A branch, you see, is just an arm of the parent company overseas. Its money and its problems are all tied back to the global bank. But a WOS, that's its own thing. It has its own capital locked away in India, its own local board making decisions, and this is the big one: if things go wrong, the liability is contained right here in India. It's just a much, much safer structure for our economy. Okay, so we get what a WOS is, and we know why the RBI is a big fan of it. But does every foreign bank have to do this? Can they choose? Well, the answer is no. For certain banks, in certain situations, setting up a WOS isn't a choice. It's mandatory.
And the answer hinges on this one super important date, August 2010. Seriously, you're going to want to circle this one, highlight it. It's a huge deal for potential exam questions. Here's the rule. Any foreign bank that was already operating here before August 2010 gets a choice. They can stay as a branch if they want. But for any new banks that came in after that date, well, the RBI can force them to take the WOS route if they meet certain criteria.
So what are those criteria? What makes the RBI step in and say, nope, you have to be a WOS? Well, to make this super easy to remember, we've got a handy mnemonic for you. Just remember the letters PICS. That stands for preferential claim problems, inadequate disclosure back home, complex structures, supervisory concerns, and the big one, being systemically important in India. If a bank ticks any of these boxes, the WOS model becomes pretty much mandatory.
Let's just double-click on that last point, because it's not just a vague idea. What does systemically important actually mean in the RBI's books? They've put a very specific number on it. A foreign bank branch gets this label if its total assets in India grow to a certain percentage of all the assets in the entire Indian banking system.
And that magic number is 0.25%. Yep, 0.25%. This is one of those high-yield facts you just have to memorize. If a foreign bank's assets here in India, and that includes everything on and off their books, crosses that 0.25% line, the RBI is going to step in and say, time to convert into a wholly owned subsidiary.
All right, we've got the why, the what, and the who all sorted out. So let's now dive into the nitty-gritty, the actual operational details. Once a bank sets up a WOS in India, what are the specific rules and regulations they have to live by? This section covers all the key compliances.
First things first, let's talk about the money. A new WOS can't just start with a small amount of cash. Nope. The RBI requires them to have an initial minimum paid-up capital of 500 crore rupees. And this isn't just a number on paper. They have to bring that money into India right from the get-go, making sure the new bank is on solid financial footing from day one.
Next up, who's in charge? The board of directors. And believe me, the RBI is very, very specific about this. They have strict rules to ensure proper governance and local oversight. For instance, at least 2/3 of the directors must be non-executive, to keep a check on things. At least 1/3 must be totally independent, with no ties to the parent bank. And critically, at least half the board has to be made up of Indian nationals. It's all designed to protect Indian customers.
And there are a few other really important rules. A WOS gets what's called national treatment. That basically means, hey, welcome to India. You get treated almost the same as our local banks. And a huge part of that deal is that they must also meet our priority sector lending, or PSL, targets. This means they have to lend a certain amount of their money to crucial sectors of the Indian economy, just like every other bank here has to.
Okay, wow, we have covered a ton of ground. So before we wrap up, let's pull it all together into one final super important summary. For all of you studying for exams, think of this next slide as your ultimate cheat sheet. This is your high-yield revision snapshot. Pay really close attention.
Let's do a quick final run-through. Remember, the core problem was the 2008 crisis and those TBTF, or too big to fail banks. The RBI's solution? The WOS model, to ring-fence our economy. The key difference? A WOS is an Indian company, a branch is not. The critical date you have to remember is August 2010. The mnemonic for why a bank must convert is PIC SAS. And the key numbers, 500 crore rupees for initial capital and the 0.25% asset threshold. And finally, don't forget they must follow PSL norms. This slide is your complete guide. And we'll end with a little food for thought. Now that these massive global banks are essentially operating as local Indian players, subject to all the same major rules, what does that mean for the future of banking in India? What's the next big thing in terms of competition, innovation, and even collaboration in our financial landscape? That's the big question going forward. Thanks so much for tuning in.